The Saving on a Valuable Education (SAVE) plan is a new, updated version of the Repay income-driven repayment plan. Borrowers currently in the Repay plan will automatically be switched over to the Save plan when it becomes available. Like the Repay plan, the Save plan bases the monthly student loan payments on a percentage of the borrower's discretionary income. However, the Save plan includes other changes that reduce the cost of the loans to borrowers. In this video, we'll review the benefits of the new Save repayment plan, starting with lower loan payments. Hey everyone, this is Andy Hill with The College Investor, investing and personal finance for millennials. If you're new to the channel and like what you hear, please hit subscribe so you're ready when our next video comes out. Thanks. Okay, benefit number one, lower loan payments. The new Save plan cuts the loan payments on undergraduate debt in half, from 10% of discretionary income to 5% of discretionary income. Graduate and professional school debt remains at 10% of discretionary income. For borrowers who have both types of loans, the percentage will be a weighted average between 5% and 10%, depending on the original loan balances of each type of debt. The definition of discretionary income is also changing from the amount by which adjusted gross income, which is AGI, exceeds 150% of the poverty line to the amount by which AGI exceeds 225% of the poverty line. So even graduate students will get slightly lower payments. This means that borrowers whose income is less than 225% of the poverty line will have a zero monthly loan payment, up from 150% of the poverty line. For a family of one, that's $32,805 in 2023, a bit more than what a borrower would earn in a year at $15 an hour. For a family of four, it is $67,500. The change in the definition of discretionary income will save borrowers in the Repay plan more than $1,000 a year for a family of one, and about $2,250 a year for a family of four. Like the Repay plan, the Save plan is limited to student debt. Parent Plus loans are not eligible. Benefit number two, no more negative amortization of interest. When a borrower's monthly payment is less than the new interest that accrues, the excess interest will be waived on both subsidized and unsubsidized loans. Since the accrued but unpaid interest will no longer be charged on the Save plan, there will be no more negative amortization when a borrower's income is insufficient to repay the debt. This means that the borrower's loan balance will no longer increase under the Save plan. Interest will no longer be charged on interest. This eliminates a source of student loan stress for low-income borrowers on income-driven repayment plans that were forced to watch their loan balance increase even when they made the requirement payments on their loans. Benefit number three, changes in time until debt is paid off. Normally, a lower monthly loan payment means the borrower will spend more time in repayment. The lower payment yields slower progress towards paying down debt. To some extent, this is true with the Save plan. More borrowers will be in debt longer until they reach the 20 or 25-year forgiveness point. However, borrowers who start off with lower amounts of debt will have the remaining debt forgiven sooner, as soon as 10 years after entering repayment. Borrowers who enter repayment with $12,000 in debt will have the remaining debt forgiven after 10 years instead of 20 or 25 years. An additional year is added for each additional $1,000. For example, the remaining debt will be forgiven after 11 years for a borrower who starts off with $13,000 in debt. Benefit number four, phased-in implementation. Normally, if a final rule is published in the Federal Register by November 1st, the new regulations go into effect the following July 1st. In some situations, the U.S. Department of Education can implement the new regulations sooner. Implementation of the new Save repayment plan will be phased in, with some changes going into effect this summer and then some in July 1st of 2024. The following changes will happen this summer. The change in the income threshold from 150% of the poverty line to 225% of the poverty line. The waiver of interest beyond the required payment will also be implemented. Borrowers who file federal income tax returns as married filing separately will have their loan payments calculated based on their own income. Spouses will no longer have to co-sign the Save repayment plan application. And then the following will happen next summer in 2024. The change in the percentage of discretionary income from 10% to 5%, the forgiveness of the remaining debt after 10 years for borrowers with low initial loan balances, consolidation will no longer reset the qualifying payment count for forgiveness. More deference and forbearances will count toward forgiveness. The automatic use of tax information to calculate the monthly payment under the SAVE plan is also a change. Automatic recertification of income and family size. Borrowers who are 75 days late will automatically be enrolled in an income-driven repayment plan. In the end, the new SAVE repayment plan contains some welcome changes, especially for undergraduate borrowers, many of whom will see lower monthly payments and less interest accrued on their balances owed. And if you have a small loan balance, loan forgiveness may arrive more quickly. However, it's important to remember that while enrollment in the new SAVE plan launches later this summer, some of the key changes aren't being introduced until next summer in 2024. Thanks for hanging out today, everyone. This is Andy from The College Investor. We'll see you in the next video.